Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF Report, July 25th, 2026. Yes, the month is almost over. And remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at the QQQs, NASDAQ 100, up 13% for the year. And we can see that it is just trending down. But right in here, we have a line down around the 680 level right in here. So you can see that it has touched it here, it has touched it there, and yesterday did not quite go down. So right now it is playing around the 680 level. Right now we closed Thursday at 691, and right now as I'm recording this on Friday morning, it looks like it's going to open right around this area, this level right in here, and we'll just have to see if it can hold in here. So the 680 level where it has touched intraday is a very, very important level for this stock right here, or this ETF right here. And we can see down here that with the Thursday close, the volume was lighter on the downside than it was the previous Friday. So we see the volume coming down a little bit on these down days, and that is a good sign. We are very oversold down here, and if we come back up here to a short-term indicator, if we can close up today, this would give us a buy signal, but it's got to close up today, and I'm talking about Friday. Now, next week is the end of the month, and usually the last couple of days of the month and the beginning of the next month, we get a positive movement in the market. So maybe this might be a good place that the QQQs are holding in there. Let us go to the ETFs this past week, and we can see that the S&P and the NASDAQ were down for the week. And when I talk about the week, I'm talking about Thursday to Thursday. So Thursday to Thursday close. And what has been the leader? Yeah, oil, because oil hit back up to $100 a barrel again. And along with it came the energy sector and the semiconductors. Even though the NASDAQ was down, the semiconductors were actually up in here. So that's pretty decent here. And technology was also up a little bit. So we have a little bit of maybe support coming into this end of the month, this coming week. And so we just might see a little action to the upside. That might be very, very nice. Look all the way down here, consumer discretionary. And we're going to look at something in here regarding this ETF. Now, let's look at the ETFs year to date, and we have the XSD, which is a semiconductor ETF, still up there, more than high double digits at 62, I'll call it 63% for the year. And, of course, oil and gas is up there. And then we come down here, technology up 24%, doing nicely. NASDAQ 100, as I said before, up 13%. And then when we come down here to home builders are up 4%. This is for the year now, year to date. And the home construction is down 1.5%. The ARC Innovation, which are mostly technology stocks of one sort or another, but has smaller stocks in there also, as well as the large stocks, down 4% for the year. And here's that consumer discretionary again, down 8.55% for the year. And back to the last slide, for the week, it was down 7.3%. So most of that fall came in this past week as the prices of oil went back up again. Now, a lot of you said, well, what's in consumer discretionary, and how come we don't have a top stocks in that ETF of the consumer discretionary, which is the ETF, and we use the XLY. And this is because when we look at like Royal Caribbean Cruises, when we look at Wynn Resorts, when we look at the cruise lines here, MGM Resorts International, Las Vegas Sands, Booking Holdings, Marriott Hotel, we're looking at very cyclical stocks. And boy, we try to keep away from as many cyclical stocks as we can. And also, we're looking at Amazon is considered consumer discretionary as well as a tech stock. Oh my gosh. Yeah, so we have Amazon in other portfolios. And when we come down here, Darden Restaurants, we have it in another portfolio. Chipotle, we had in our growth portfolio for a while. Decker's Outdoor, we had and have in one of our portfolios. Tractor Supply comes in and out of the portfolios. So what I'm getting at is that rather than getting into these stocks that have high ROEs at the present time, and I'm talking about clean surplus return on equity, because they are so cyclical, we don't even bother with this XLY as a whole, but we do pick out some of the stocks and put it into our other portfolios, such as a dividend growth and income portfolio or even the growth portfolio. So that's why we don't even get into consumer discretionary, are all over the place like Amazon. Should this really be a consumer discretionary stock? And so we look at that and we say, okay, this is kind of a conglomeration of I don't know what. And we'll pick some of the stocks if they fit into our other portfolios, but as a whole, we don't even want to go near consumer discretionary because of the cyclicality. And what has this done over 5 years? Well, the black line is the S&P 500, up 69, call it 70% over 5 years, and the consumer discretionary is up almost just 1/3 of that at 24, call it 25%. So we're looking at an area here that underperforms the S&P 500, and we don't even like to look at ETFs that are underperforming the S&P 500. We'd rather look at ETFs that outperform the S&P 500, and then we'll pick stocks from those because that's where the best stocks are. Now, here's something I want to show you. Now, you've seen this before, and we are the top stocks that we picked out of the XSD semiconductor, up 43% for the year. It's underperforming the ETF itself, which is odd for us. Usually our top stocks outperform the ETF itself. But here's one, it's up only 43%, and I say that tongue-in-cheek because up only 43%. I'll take that any day of the week. Now, our XLK, the technology ETF that we have, the XLK is up a nice 24%, and our top stocks are up 36%. The NASDAQ 100, up 12.9%. This is the portfolio that's taken straight from our computer program, up 17.5%. Very, very nice in there. S&P up 8.22%. And we compare our growth portfolio to the S&P 500, up double that, and it keeps doubling it all this entire year, up 16%. Nice return, folks, for the first half of the year. Now, the home builders, we took the home builders and we took home construction. You can see the home builders ETF up 4%. And the home construction down about 1.5%. What we did was combine the home builders and home construction because a lot of the stocks that are in home construction are also in home builders, and ditto for the home builders, they're also in home construction. So rather than overlapping the stocks and having two separate portfolios, we picked out one, and it is up a nice 9.3%, which is more than the S&P 500. So we're doing very, very nice there. And then we compare the ARK Innovation ETF with our technology top stocks, and that's a big, big difference right there. Our dividend growth and income portfolio, including the dividends of about 3.5%, started the year out at 3.7%, up 12.1% total. So again, it's outperforming the S&P 500, doing very, very nice in there. Now, here's the big surprise. We are coming up with a rating system. We've been asked about this for a long time. And what if we took out a rating system of the top stocks in our indices? And we have about 800 stocks that we used as a trial period, even though our computer program online covers about 1,800 stocks. But we took our 800 stocks because we have more information in those and it's on a spreadsheet, Excel, so we can maneuver it a lot better than the computer program on site, just because we have more columns and we test that all the time. That's our test portfolio. And no, nobody has ever seen that except for very, very few people. But we've took that portfolio and we had rankings of the clean surplus ROE, revenue growth, net income growth, free cash flow, and we tried various methods of how do we rank those 800 stocks, and the 800 stocks include the S&P 500 and the NASDAQ 100. So we have the main stocks in that portfolio. So our exponential ranking trial, number one, we have number one and number two, and really what they are is different weightings of the clean surplus ROE, the revenue growth, the net income growth, the free cash flow, and the free cash flow growth. So we had just different weightings. These are the same stocks, but they have different weightings in them. And we are looking at some very, very nice returns, because when we look back at our growth portfolio, we pick out our growth portfolio mostly from those 800 stocks, because a lot of the stocks in the 1,800 stocks on the computer program don't have a 10-year operating history. And we like stocks because we want to be a little bit more conservative. We want a more consistent, and in research terms they call that standard deviation. We want a more consistent portfolio because we don't want to get very, very wild on the portfolios that we say we think you should invest in these portfolios, and you subscribers are following those portfolios. So we are taking the same stocks that we take out of our growth portfolio and changed the rankings of the clean surplus ROE and the growth of net income, the growth of revenues, and the growth of free cash flow. And we're coming up with some pretty nice numbers in here, folks. So that's what we're going to see. And we're looking at what's it going to take to put on our website and how to get it on the website, because when you put something on a website, it's one thing having your stocks in an Excel portfolio, which we have to update manually, but once we automate it and put it on the computer so that you can use it, it takes a lot of programming. And so we're looking at, can we use those 1,800 stocks? But a lot of them are taken out of this group because they don't have a 10-year history. We have a lot of new stocks coming on. I mean, just look at the S&P 500. It'll change 15 to 30 stocks a year, and it throws out the what they call the dogs and brings in the up-and-comers, but a lot of them are just 2 and 3 and 4 years old, and we have trouble picking a stock that doesn't have an operating history. We want to be safer in that area. But this is very, very encouraging, these numbers right here, and this is something that's coming, that's new to our programming and to the money managers out there who are subscribing, because they can use it for their clients and they can look at their client statements and say, okay, how is this stock rated? What we're figuring out now is how do we get it on the computer program so that people can use it, especially money managers. And this is very, very promising so far in here. So folks, we had a crazy week this week. The NASDAQ 100 is drifting down, where it's trying to make a bottom in here. It's in oversold territory right now, and we're coming into the end of the month this coming week, and usually we have a positive bias going into the end of the month, the beginning of the following month. So folks, forget about the market. Go out this weekend, be with your loved ones. Most of all, be safe, be healthy, and folks, we'll see you back here in a couple of days.